Let's get to this breaking news on the tariff front. We didn't have to wait until so-called Liberation Day next week to get more complications globally on the tariff fight, with the U.S. pushing ahead with harsh tariffs on automakers and threatening more sweeping trade levies ahead. And beyond hurting auto stocks, it is reinforcing investor concerns about the hit to global economic growth. Obviously, we've heard Prime Minister Mark Carney talk about a plan to respond. As for how Canada's economy is responding to this, let's get some perspective now from Royce Mendes. He's Managing Director and Head of Macro Strategy at Desjardins. Royce, every day brings a new tariff threat. What do you make of this latest one?
Well, it's a very important threat to the Canadian economy if it goes ahead in full force. But that's a big if. I mean, all of these conversations that we're having with clients revolve around these scenario analysis about if Donald Trump does something, then this could happen. But you really don't know in this sort of environment, first of all, with Donald Trump's penchant for changing his mind, but also what the scenario will look like 6 or 12 months from now, because there's a lot of complexity in the situation. So right now, Trump is generally trying to restructure the global trading system. It's a massive endeavor. It's never been done before. There's no good way to model out exactly what's going to happen. And I think there's a lot of forecasts out there that are employing false precision. And so what I would rather focus on at times like these is thinking about, broader strokes. Where are bigger trends happening? I mean, we know that countries like Canada, countries in Europe are tilting towards defense as a way to shore up some of the weaknesses that are emerging in their security systems. These are things that I think we can focus on. But the individual daily news flow from the Trump administration is almost too much to absorb and put into models every day, because you'll come up with numbers that are moving so wildly they become useless.
Well, let's go through some of the numbers that we do know, Royce, when it comes to Canada's economy, and some of these come from Bloomberg. First of all, when it comes to the auto industry, more than 90% of Canada's passenger car and truck exports are U.S. bound. So we have to start to figure out ultimately what comes from this trade war on that front. The tariffs ultimately would be a blow to manufacturing in this country, which shipped nearly $50 billion of vehicles into the U.S. market last year. Now, the Prime Minister, Mark Carney, who's now busy on an election with an election campaign, going back to Ottawa to deal with this, calling the new tariffs on cars and light trucks a direct attack on Canada's auto sector. But you talked about Europe as well. And in the early days of the Carney leadership, we saw him make a trip to Europe. And what was interesting off the top of the program, we highlighted another threat from Donald Trump for basically Canada and Europe to be careful in any alliance they form in fighting back. How, as an economist, do you navigate that part of the story? Because obviously, doing so, on the one hand, might be prudent for Canada. On the other hand, is it a huge risk for Canada to take that step if literally the president is warning them not to do that?
Yeah, I worry that this is signaling, because looking around the world, what you'll see is that when there's a small open economy or smaller open economy near a very large economy, those two economies tend to trade a lot together, and the smaller economy relies a lot on the big economy. It's difficult to reorient away from the large economy that's close geographically. It's almost like a magnetic force. And so, I think looking at diversifying our export markets is a great initiative. And, we probably should have done this years before. But any reorientation will, first of all, take time. And if it were successful, it would fly in the face of a lot of years of history where these sorts of attempts have met pretty significant challenges. When you're close to another big country, it's easy to sell from them. Transportation is cheap. You can get the goods there very quickly. When you're trying to sell to an economy, a large economy that's further away, there are difficulties with that that are an ocean away. So I think it's a good idea. I think it's an initiative that needs to be talked about, but I worry that we won't see many gains in the short term from it.
Okay. In light of that, I think everybody's trying to figure out, well, then what is the game plan outside of the rhetoric? What kind of supports are we going to see? And we've already seen some announcements, from the federal government on its game plan there. And then what role central banks play in all this? Now, the Bank of Canada's next interest rate decision is basically, I believe, mid-April. So call it a couple of weeks before we end up having this federal election. It's almost like we've got Liberation Day to start April, a Bank of Canada interest rate decision mid-month, and then the federal election. If you're the Bank of Canada, what do you do?
Kudos to the Bank of Canada for coming out in recent weeks and saying, we're going to move to the sidelines. We don't really have any confidence in a specific scenario or outlook. And so we can't change monetary policy based on what ifs. And that's really exactly the way I'm thinking about things right now. It's that you want to stay close to home. I mean, on the one hand, tariffs, retaliatory tariffs, and currency depreciation can push inflation higher. And the Bank of Canada has a single mandate to keep inflation low and stable at a target of 2%. And you don't want to be easing monetary policy if inflation and inflation expectations are drifting higher, which they seem to be doing right now. But of course, if we start to see massive job losses, then the Bank of Canada has to act. But I think they're going to wait until they actually see any sort of weakness in the hard data. So far, the hard data has held up relatively well. It's not been great in the past couple of months, but it's been okay. It's been okay enough that the Bank of Canada should probably pause its interest rate cutting cycle. It's done a lot. It's been one of the most aggressive central banks globally in cutting interest rates. It should probably pause, wait till the dust settles, and then later in the year, I fully expect them to return to cutting and cut pretty significantly after they see the damage to the economy and maybe inflation and inflation expectations settling back down.
What does that mean? What does cutting aggressively mean?
Look, I mean, our base case is that the Bank of Canada cuts its policy rate down to 1.75%. We talk a lot about the drag from the trade war. The cutting of the elimination of these carbon taxes, both federally and provincially, will help lower inflation in the short term, should help keep a lid on inflation expectations, giving the bank an opportunity to cut after that happens. But I will also say we have domestic challenges. The mortgage renewal wall, which we've talked about a lot, is now biting. The population growth slowdown is showing up pretty clearly in the data. These things probably require interest rates lower than they are today. I just think for the near term, the bank probably needs to just move to the sidelines, let the federal government, provincial governments talk about how they're going to support Canadians in this time of uncertainty. And the bank should really be focused on its inflation target. Once it gets a clearer picture of what the trade war is doing to inflation, my assumption is that it'll be a short-term increase in inflation expectations. It'll start to come back down in the latter half of this year. They can get back to cutting.
Always great to get your perspective, Royce. Thanks for making some time again this morning. Lots to watch. Royce Mendes, head of macro strategy.